can have that. All right, we are recording. And for those of you who know, you're in room 3, but you're seeing me. I'm not Danny Randazzo. I'm Dan Hanford. Danny and I switched rooms because he's running, and I figured it'd be a good idea for him to run the panel that's happening right now as well. So, but I want to be here with MC because I know there's a lot of things that I want to be able to learn from MC and things like that. So I was really interested in MC's session here. So of course, all the sessions are being recorded, so you'll be able to watch any of these sessions that you want after the summit. So MC is an investor, wealth strategist, educator. He's the president and CEO of Producers Wealth and the creator and host of the popular and top investing podcast, Cash Flow Ninja. His purpose and mission is to help producers and creators create, protect, and multiply their wealth in any economy without getting ripped off by Wall Street and their governments. He challenges existing societal belief systems and misinformation around concepts such as money, saving, investing, retirement, and wealth. And so without further ado, I want to turn it over to you, MC. And for those of you who are attending this session, I want you to make sure that you save your questions towards the end. Let MC get through his presentation. Then we'll have some time at the end for a live Q&A with MC. And MC, when we get to that point, I will go through these questions and things and tee them up for you, okay?
Fantastic. Sounds good. And I really appreciate this opportunity to speak with everyone and share some of this. So very, very honored to be here. So what I'm going to share today is how to supercharge your multifamily investments and find capital from investors that they did not know that they could tap into. It's an area that when I started getting into what I'm going to share with you today about a decade ago, I didn't realize how much I did not know. And there's still things that I learn every day about even this space that I'm in. So I'm pretty excited to share just what I've learned on my journey with you. So let me just make sure. Here we go. So Dan had just mentioned a little bit about myself. So I do have a show called the Cash Flow Ninja, which I've interviewed some guests on. So just a little bit of background: Robert Kiyosaki, Grant Cardone, Jim Rogers. And one of the reasons and why I'm sharing this is I've been very, very interested in studying money, finance, and modeling what successful people do. And I've been very, very blessed through my show. I continue to do that. I continue to model just what I learned from guests on my show. And I've been able to do that over the last 3 years. So a lot of what I'm going to be sharing today is not something that I came up with. It's something that I saw, I modeled, I started doing it in small increments in my own life, and saw just saw the difference that it made. So as Dan mentioned, I'm also the president and chief wealth and investment strategist at Producers Wealth. We work with entrepreneurs and business owners and investors to develop a strategy that helps them to create, protect, and multiply their wealth outside of Wall Street. So we're a little bit different. I usually say it's almost like watching a Seinfeld episode, the one where George Costanza comes in and says to Jerry that his whole life has been the opposite of what everyone has told him to do. Well, we do the complete opposite, I guess, what a lot of folks teach out there. So one particular is the cash flow as opposed to the accumulation model. But we assist folks in over 45 states virtually, based out of Newtown, Pennsylvania, and the ability to do business in all 50 states. So in today's discussion, I'm going to share a lot of content, but I just wanted to talk a little bit about context, right? And set the stage, because it does require a little bit of a mindset shift. And I want to congratulate you for being here already. By being here, you have already changed your mindset and saw that there was different ways of doing things out there. And you were willing to invest in yourself to learn more, to seek out more knowledge. So with that being said, one of my favorite books that I've read is The One Thing by Gary Keller. And in the book, he talks about the surprisingly simple truth behind extraordinary results. Very focused, the one thing, right? So when I looked at, from a contextual standpoint of explaining what we do and what I'm going to talk about today, I thought to myself, well, what's the one thing behind surprisingly the simple truth of extraordinary financial results, right? because we see it everywhere. We see very successful folks. We see folks that are reasonably successful, and then we see folks that are struggling. And what I always try to do is I try to reverse engineer things, right? When I look at the end result, I try to reverse engineer what I need to do to get to the end result, right? If I want to lose a ton of weight and be healthy and look a certain way, I try to reverse engineer what I need to do to get there. So I thought I would do the same thing quick from a contextual standpoint when it comes to finances and when it comes to money. So why do people struggle? We've covered mindset a little bit in worldview, right? Worldview of scarcity versus abundance. I often joke and say we live in a time where if any of you guys watch Star Trek, when they're on the Enterprise, they were speaking to other folks through screens, right? Through TVs. We have that technology today. It's free. We are living in a very abundant world. Financial literacy and education, that could be a presentation in and of itself. It's not taught in schools. The wrong data and information, not just where you're getting your information from, but it could be wrong and it could be misleading and it could be benefiting certain folks. The wrong role models, mentors, coaches, advisors, and of course, not taking action. That's very low-hanging fruit. You'll never be successful, and you always struggle if you don't take action on something. But the biggest thing that I've seen, because I've seen folks that do all the things that I just mentioned and don't have a problem with that, is they didn't have a strategy. So what I'm going to share with you today is a strategy to increase the returns for your multifamily investments. If you're a multifamily investor and you're already a cash flow ninja, this might put a little bit of juice on what you're doing already. And this is also... The strategy will also lead you to ask really good questions if you're raising capital from other investors out there that they might not even be aware of that they have or have access to. So strategy. Let's talk about strategy for a little bit, because markets go up, down, and sideways, right? I always say if you don't have a game plan or a strategy that works in all three of those, you do not have a strategy. So what's a strategy? Dan said in the beginning, in my introduction, I question a lot, and I challenge a lot of concepts, right? Because it's very, very important, the meaning of words, because they've been so used out of context that we've lost really the meaning of words, and we just throw them around: savings, investing, speculating, and so forth. So what's a strategy? We hear people throw this around constantly. Well, the Business Dictionary defines a strategy, a method or plan chosen to bring about a desired future, such as an achievement of a goal or solution to a problem. And then also the art and science of planning and marshaling resources for their most efficient and effective use. The term is derived from the Greek word for generalship or leading an army. When I think about strategy, for me, it's a strategy defines why and what and how I do what I do, right? Also, it defines what I own and why I own it. Why do you have multifamily investments, right? What is the strategy around that? And how does what you own and what you do and how you do it get you closer to your objectives, your goals, and your vision? So that's what a strategy means for me. So now that we've contextualized that a little bit, I think the rest of the building blocks will fill in. I love watching golf. I'm a horrible golfer. I'm originally from South Africa, so sometimes people think I can play golf because I am, but I love to watch it, and Ernie is one of my favorite golfers. And I always talk about a strategy also being the swing, not the club. I think we're focused very much on the golf clubs and everything that we do: mutual funds, ETFs, real estate, gold and silver, Bitcoin, golf clubs, which we don't really just focus on the swing, because there's different tools to use in different parts of the course. So we could also look from a strategy. And if you've ever read Rich Dad, Poor Dad, one of his best books, in my opinion, is The Cash Flow Quadrant. These are strategies. This is how we all fit into the world, right? This is where everyone fits in. E, of course, is for employee. S is for self-employed. B is for business owner. And I is for the investor, the goal of where we all want to end up. And that's why you're on this on this webinar and this presentation with me, because that, of course, is the most desirable place from a tax standpoint and from an income standpoint, right? The most efficient income that you receive is out of those quadrants. So that also fits into that. So about 99% of the advice that you're going to get and data that you're going to get isn't just wrong or counterintuitive, but it's very, very dangerous. So this is where the majority of the folks get their news from, or their information. So we're very much focused and arguing about golf clubs and not about the golf swing. Tiger Woods has a coach to help him, not to pick out clubs, but to help him fix his swing. So I want to talk about, within a overall strategy as an investor, your best investments, which is, that it's you, your best one is yourself. That's why you're here, spending your time and growing your mental capital. Your relationships, which this is a great place to also network with folks and learn and meet other folks. And of course, your business. Everyone is a business. Jay-Z talks about, that he's not a businessman, but he's a businessman. So you're a businessman or a businesswoman. You are a brand. And especially if you're going to be in multifamily investing, you're going to be a business. And of course, passive income, which is the goal that we're all here, right? So this is just a quick formula that I also wanted to share with. This all ties in. Your mental capital times your relationship capital is your financial capital. Mental capital being what you read, what you study, podcasts that you listen to, and so forth. Relationships, obviously your team, mentors, coaches, and so forth, which eventually comes there. So in a strategy, from a strategic approach, the focus, and that's why I love to reverse engineer things, where a lot of folks focus is on the financial capital, right? But the two combined with the mental and the relationship, that's going to result in that. So if you break it down and reverse engineer it, so in an overall, from a strategic point of view, that should be the main focus. And of course, what includes a strategy? Right, that's going to work in a market going up, down, and sideways. Well, control, alignment with your unique ability, so growing that mental capital to learn, know what you're investing in, focus, which is why I led with the book that I led with to start this conversation. Focus, obviously, being a big one, staying in your lane, as folks would say. Protection is a big one. Risk management. There's 4 different risks that I talk about. Political is a big risk. Economic risk, and then there's market risk and institutional risk, right? Dollar maximization, and this is going to tie into what I'm going to share a little bit more, of $1 doing many different things simultaneously at the same time within an overall strategy, right? Integrating. And then efficiency, which, if we talk about efficiency, not to jump into that too deeply, but it's efficiency against the wealth destroyers, taxes, inflation, fees, opportunity costs, which I will say quite a bit and what I'm going to dive into. And of course, from an income standpoint, I already pointed out that the most efficient income is that from as an investor. So this is just a quick overview of how I've modeled and try to build what other folks has built as far as an overall strategy and a plan. Control being one of the most important things. Efficiency from a tax perspective on the side, you have to have a tax plan in place, and that's why we're here talking about multifamily. Risk management, I just covered. Legacy is obviously there too, right? Estate planning, we want to create and produce, but we want to transfer things efficiently to our children and the rest of our family. Protection of the family constitution, one of the most important things for me, writing down a core beliefs, your family, a mission, a vision, and all of the things that go around with that, what the family stands for, how we do and react in certain situations and certain rules, right? And then inside of that is protection of assets and income. And then we get to the fun stuff, the wealth insurance, which is gold and silver, production, which is you, protection, which is where a lot of insurance comes in, and liquidity, where we warehouse our money to invest, income. Now we're getting into the fun stuff, multifamily real estate and growth. There's several different strategies, and speculation right at the top. Where most people start is completely upside down. They start in the small little triangle right in the middle with speculation. So that's what I mean, an overall holistic strategy, just to get some context to behind what I'm going to be sharing. So as far as where folks are operating to and setting goals, and maybe regardless of where you are in your journey, this is also good to know when I use different words in this conversation. Financial security is about 6 to 12 months of operating expenses for your household and your business, okay, in a safe place. And then also protecting income down the future. There's strategies for that. Financial independence is when your passive income covers all of your living expenses, right? Then you become financially and economically independent. There's strategies for that. Financial freedom now, of course, there's a different number attached to that. And then financial significance is obviously what next. So financial freedom, I talk about when money is not the main factor, whether you do or not do something. So this is a quick overview of systems and processes within an overall strategy: your production, which is you; liquidity, where you warehouse your money; and then, of course, the income, the assets that you invest in, the growth, and then obviously the legacy plays into the transfer of it. So let's talk about strategy and how we're going to put some fuel onto what you're already doing as a multifamily investor and how you can increase some returns. So there's a 3-step process really that I talk about. You have to make money, you have to protect money, and you have to multiply it, right? So I talk about cash creation, cash capture, and cash flow creation. So I keep it very, very simple. So we create our money in our business, whether it be a job, whether it be a business that we're operating, we have to put it somewhere. And that's what I'll get to in a second. And then we have to deploy it for it to multiply, right? So we create, we protect, and we multiply. We're all in the business of multiplying capital, and that's why we're here. So going back to that slide, I'm just going to go back 1 second to this quote. One of my favorite quotes when I look at the system comes from Ken McElroy, Rich Dad Advisor, who talks about business creates liquidity, the liquidity for the real estate that you invest in, and real estate creates wealth. So back to the formula that I have here, the system. Cash creation is in the business. Cash capture. So there's a couple of different things in cash capture that we talk about. The first one is cash flow recovery. Now, this could be a presentation on its own as well. There's a ton of cash flow leaks that people have of money, whether it's their personal economy or whether it's their business or their investment economy. There's a lot of things that we could do to be more efficient, right? And once you identify those things and you do plug those cash flow, quote unquote, leaks, and you recover some of that, now you have to automate it. Otherwise, we're going to fall into that trap of Parkinson's law, where our income basically and our expenses rise with our increase of this new money and our income, right? And then cash flow banking, which I'm going to talk about because this is really the core of what we're doing, and that's why cash capture is in the middle. You make it, you protect it, you warehouse it, you put it in a vault where it's efficient, and then we're deploying it to multiply it. So what's cash flow banking? Now, we've heard about cash flow banking or different other terms: infinite banking, bank on yourself, the 770 account, the president's account, high cash value life insurance, and more. So it's a strategy that allows you to reclaim the banking function that utilizes a dividend-paying whole life insurance policy with a mutual insurance carrier. The policy is structured for maximum early cash value from year one. So a lot just said there, and yes, the insurance word is in there. So just to state that again, it's a strategy that allows you to reclaim the banking function, which I'll get to what that is in a second, that utilizes a dividend-paying whole life insurance policy with a mutual insurance carrier. Mutual insurance companies are outside of Wall Street. They're not stock companies. They're not listed on the stock exchanges. They're completely out of that casino. So they manage the company on behalf of the shareholders, which is the policy owners, right? So it's a little bit of a different philosophy where they don't have to take ridiculous risks, ring a bell and announce earnings like a lot of these other stock company and public companies have to do. So what about these two folks, right? What would they have to say, what I'm just sharing with you guys? Well, that's why I was speaking about a strategy, because the insurance vehicle that we use in this strategy is just another vehicle. It's the same as real estate. It's the same as, the other paper assets. It's the same as commodities. It's the same as businesses. It's just another vehicle. The strategy will determine the success of how it's used. So, by the way, I do agree with a lot what Dave has to say when it comes to insurance, the way that it's packaged and sold to the majority of the folks on the street and the majority of people out there. He makes really, really good points, and I actually agree with them, because that's one of the first things that people would say, well, Dave Ramsey says it's horrible. I agree with Dave, the way that it's packaged and sold to the majority of people out there. It's a strategy, though. There's another strategy. So how is it horrible for one group of people as a place to warehouse cash, as opposed to where family offices warehouse cash, where they have net worths of $100 million and up, right? So there's something missing. How do people lose a lot of money in real estate, and a lot of people create financial freedom in 5 years or less, right? It comes down to strategy. But let's talk about the banking system for a while, because this is the strategy. So I am really going to break this down in a very simplistic manner. So I understand that you might be thinking, well, what about fractional reserve banking, MC? You didn't cover that. Well, what about investment banking arm that ties into it, right? We're going to keep this very, very simple. So a very simple banking model, as it used to be before the merger between investment banks and traditional banks, is there's a deposit side and a lending side in the banking system, right? So you would deposit money into a bank, and they used to pay you something, and they would take that money and then lend it out to folks that either have small businesses, mortgages, they're going to college, and so forth. So using this example, just to explain the mechanics of a bank and how we would model similar behavior, if you would deposit $10,000, for example, in a bank and earn and the bank would pay you 1% on that, because you have online bill pay, I guess, which is some of the other things that they offer. They would pay you 1%, but they would take that same $10,000 and lend it out at 10% to maybe a small business owner, or a student loan or a mortgage, and so forth. And this is just for simplistic math, right? So the 1% on that, the $10,000, they would pay you $100. On the other side, they would lend it out and borrow it at 10%, and they would get $1,000 back. And a lot of people would say, that's great. That's a 9% kind of, just a arbitrage there. And they made some decent money. The profit, of course, would be $900. But the only money, if you think about it, that the bank truly had in that transaction, because they didn't have any money before that $10,000 was in, right? Somebody deposited that 10, and then they used that 10 and lend out that 10, was the $100. That's the only transaction that the bank had in this whole process. And that's why it's not a 9% profit, but it's actually 900% if you look at the model. So how do you model similar behavior, and how can you use this simplistic banking model to create a system for yourself within your own personal and your own investing economy? So I just want to touch quickly on why we use the insurance vehicle for what we do as our cash capture. Remember, we create, we capture, and then we create cash flow, right, with our investments, because we have use, control, and flexibility of it. So when you put money into insurance contract, you can use the money in that contract. Okay, you have complete control over that. There's flexibility in funding it, flexibility of taking money out of it, and flexibility of money paying it back in this own system that you would own. There's immediate access and liquidity through policy loans. So you don't have to wait years, again, like what is told to the regular public, to actually access policy loans. It's available very, very quickly. There's guarantees on the principal, 4% over the life of the policy, and then the built-in growth, and then there's obviously dividends, which is not guaranteed, but dividends, some of these companies have paid dividends consecutively for over 100 years. Some of them paid them since 1847. Not guaranteed, but they've been very, very, very profitable, these companies. Tax-deferred growth and untaxed distribution. Here's the beauty of it and why it fits in so well into the system, is the money inside these vehicles grow tax-free. So it's after-tax money that you put in. It grows tax-free in this money, or in this vehicle, rather. So that's why it's so efficient to warehouse it in there, as opposed to a lot of other different places that you could put it. There's no contribution distribution limits. So unlike IRAs and qualified retirement plans, which this is not in the same world as that, but there's no limits onto that. So as much as insurance companies will underwrite you for, you'll be able to put in there, right? So they take income into consideration, they take net worth into consideration and more. It's a private contract, which means it's not, you can't look this up publicly. So when you take policy loans, it's not reported on credit reports. There's asset protection, which in 50 states, some shape or form. Speak to a lawyer about this, because every state is different, right? So there's, for instance, some states where it has full asset protection and no one actually can touch it. And then some other states is very, very limited. So there's still ways in protecting it through proper estate and asset protection planning, but you have to be cognizant of this. So please don't take it as a blanket statement that nobody's ever going to be able to touch this, because every single state is different. There's flexibility in funding, as I mentioned. The access and the payback, continuation. So if there's a disability, or if, there's a life event that happens, there's some things that you can build in. And then obviously from an estate planning, because that's why I put the whole system together for you nicely. A big part of it only is not just to produce and create while we're on the spinning bowl of dirt, but it's also to leave a legacy and pass something down. And this is where this kind of plays into for efficient transfer to the next generation, with, of course, income tax free to beneficiaries. So what we're doing here, the strategy, what it involves in, is collateralizing an asset. So what do I mean by collateralizing an asset? So in the 70s and the 80s, we were in a very high interest rate environment. So some banks would actually pay double-digit interest on a CD. So you would go into a bank and say, Mr. Banker, I would like to open up a CD with your bank. I have $100,000 I'd like to put in, and the banker would say, well, absolutely, not a problem. And let's just say they paid you 10% on that money, right? But now it's in a CD. So, but now I'm running into a real estate deal, or there's a syndication that I want to be a part of and participate in. Well, how do I get to access that money now? Well, I could go to the bank and then say, Mr. Banker, I have $100,000 here in a CD. Can I get a loan from this bank secured by that CD of 100,000? And the banker would look at you and say, well, sure, I'm in the business of lending. That's my business. And they would give you a loan for, let's just say, 90% of that money. So they give you $90,000 to then invest. Let's just say it was at that stage at 15% cash on cash, or maybe, you could pick a number. Then you would buy that real estate, and the cash flow would then pay down the loan from the bank. So what you essentially have done here is have money working in many different places simultaneously. So we have money that we put into the bank, earning interest on that CD. We collateralize that money. Remember that the $90,000 loan that I got did not draw down the account value to $10,000. There was still $100,000 that was earning 10% annually. The $90,000 was then used and leveraged to invest in cash flowing real estate. And then the cash flow from that real estate is then used to pay down the loan. And there was actually quite a number of folks that this is what they did, and they did it over and over. So That's kind of the model of collateralizing assets. Can you do it with other asset classes? Absolutely. I looked around quite a bit to see how it was different folks was doing different things. So one other area, for example, is asset-based lending, which is a stock portfolio, right, of dividend-paying stocks where there's certain financial institutions that will give you a certain amount of money with that stock portfolio as collateral. So we're doing essentially the same thing here inside of an insurance policy because, well, it has the tax-free growth and then the death benefit and then all the other things that come along with it. So just to give you a quick overview of what we're doing here and creating is we're putting money and funding it into a policy that earns dividends, that has guarantees built into it, okay? The dividends are not guaranteed, but again, it earns dividends if it's set up with the right carrier. We then leverage the money from that to acquire an investment that produces cash flow. The cash flow is then used to pay down the policy loan, which the policy loan is a loan that we got with the cash value of the policy as collateral. The same as what we did with that CD. So that's essentially what we did here. So in the business of multiplying capital, the money was then put into from cash creation to cash capture, right? Where we efficiently position the capital to do many different things simultaneously with tax-free growth, a tax-free bucket, and then it's leveraged to then invest in the real estate, and then and then we keep doing it over and over again. So how does it play into real estate? So same way. So we would fund the policy. We'd take a policy loan with the cash value as collateral, right? Which 90% of the available cash value would be able to access that for a policy loan. We either put a down payment or in the multifamily syndications, we invest in a syndication and the cash flow from that is then used to pay down the policy loan. So with real estate and insurance, and there's a lot of similarities in the tax code that this is written. When you really get into the weeds, it's kind of comical because it shows you who actually writes the tax code. If you look at what the ultra wealthy, affluent, and big institutions are doing with their money, I'll give you an example. There's in real estate there exists a 1031 exchange, and insurance is a 1035 exchange, right? So on the life insurance side, there's cash flow on both of them. There's liquidity. The cash flow is obviously the liquidity on the real estate, and tax advantages, equity appreciation, controlled leverage, and inflation hedge on both of these. So just a quick case study that I wanted to share. And this is just from a pretty high level. I'm not going to dive down into the weeds very, very much because I think my goal with today's presentation is to give you basically the framework to show you the strategy and the flow of how this is done. We could always look at individual cases of how this is done, but let's just say a 40-year-old male, his passive income is $360,000 a year, right? That's his goal. That would be an income replacement for him. And he wants to do it through directly investing in real estate syndication. Let's just say that he could invest and get 8%, right? And he's willing to save and invest about $200,000 a year, put that towards his goal. So what results? And again, for this example, I broke it apart. I did not roll back in the cash flow and the returns every single year. But if you completely do not reinvest any of the returns, it would take 22 and a half years. The $4.5 million would be deployed. The passive income goal would have been achieved. Again, we didn't reinvest the yearly cash flows from the syndication because I just wanted to break it apart to show you the power of integrating these two vehicles instead of just doing one versus the other, right? So this is still good. If you reinvested that, if you run it with a calculator, you're probably going to end up just by eyeballing it, probably 10 to 14 years. That's probably going to be your window and framework of when that's going to be accomplished. So still fantastic So how can we do things a little bit better, right? How do we put a little bit of rocket fuel on it? So let's just say he funded a cash flow banking policy first, then he invested in real estate. He still did the $200,000 to cash flow banking per year. What would some of the results be? Well, again, we didn't reinvest the cash flows because I wanted to break it down nice and clean. But in 20 years, the $4.5 million would have been deployed. The passive income goal of $360,000 per year would have been achieved. And as a bonus, because it was run through the insurance first and then invested in the real estate, integrated as part of an overall strategy and the system that he had, there was $1.46 million tax-free additional with a death benefit to transfer liquidity efficiently to the family trust if there is, right? So that's a nice sum of additional money by just tweaking a little bit and putting a little bit more fuel on what you're doing already. So that's why it's so powerful of integrating this. And this is some strategies that they employ in family offices. And back to the Dave Ramsey question of, the one thing you hear, the one is bad, the other one's good. Well, it's just a strategy. It's a strategy that you have using vehicles. We all have access to the same vehicles. We don't have access to the same strategies. So that's the difference between the two. I like to think of the insurance vehicle as the and asset. So meaning you don't have to choose. And this ties into the opportunity cost that we discussed earlier, which is a huge wealth destroyer, right? So usually in life, we can either save or invest, or we can do one thing as opposed to another. And there's consequences. There's most definitely, benefits of doing one thing versus another, right? And there's negatives also. But in this case, by integrating the two, we were able to put our money in a place that's safe, with guaranteed growth, tax-free, that's going to tie into estate planning and do other many different things, and able to leverage it, combining it with real estate. And all of a sudden, now we have an and asset because we don't have to do this one or this or the other one, right? We could do both. So from a syndicator standpoint, right, this is a conversation to have with when you're raising capital. So there's a lot of, I go to a lot of meetups. I have a meetup in the town that I live in as well, and I've been to quite a number of presentations. And folks usually a big pool, obviously, cannot miss the IRAs that's available. What is it, $9 trillion or something that's in there approximately, and only 3% is invested outside of Wall Street. So a lot of people look at self-directed IRAs. A lot of people look at qualified retirement plans as a source of capital. But there's a lot of families too that are not aware that they have, or this might be something that mom and dad or grandparents have put together for children as well. So they're not aware that they have this. So this might be a good question to ask as well. So that's why I posed a couple of questions here. Have you ever asked potential investors if they have cash value and permanent life insurance policies? There's quite a number of them that might have it. They know they have it, but they just don't know how to use it to invest in deals. Right? So some folks know, and I've had a conversation with many after they listen to my show and we share some of these strategies that said, I never knew that I could do that. Now I have access to, $100, $200, $300,000 actually for real estate deals that I can use to start my real estate investment journey. So this might be a great place to have a conversation with them. And the other question that I would say is, if you're having conversations with folks and asking a question, do you think that you might find additional funds for them to invest? Now you're a person that just, you've provided value, right? And that's the big thing is, do you think that you be of value to them to share this vehicle as another vehicle to position liquidity for investments? So this might be another conversation to have as well. By the way, if you didn't know about it, there could be some cash available in permanent life insurance contracts for you to invest in real estate. And if you don't, this might be another vehicle. If you're tapped out on IRAs or solo 401ks, this might be another vehicle to consider. The Wall Street Journal actually call it the rich man's Roth, I believe was the term that they used, but this is another vehicle, right? So just another vehicle. So if you're using self-directed funds already and out of your own to invest, this might be another vehicle to look at to warehouse some savings efficiently, a tax-free bucket. as well. So the one thing, how I started this conversation was the one thing. Great book if you haven't read it yet, because it breaks down a very a concept that we know already, right? It's one of those things that put in a certain way, it's very enlightening and very inspiring. The same, like, for example, one of my heroes, Hal Elrod, wrote a book about the miracle morning. It's the same thing that's very simplistic about getting an early start and having a morning routine. It's right there, but put in a certain way. It just really, really is inspiring. So the one thing, the surprisingly simple truth behind extraordinary financial results, and I would say it's a very powerful strategy. It's not just vehicles, all right? It's the strategy that you combine and integrate vehicles with, and then obviously build processes and systems and processes around that. The firm of mine that we specialize in this is Producers Wealth. You can check us out at producerswealth.com. And also for folks that are interested in learning more, there's a free course and a webinar that you can have access to, yourownbankingsystem.com. We just shared and get a little bit more into the weeds. This is kind of the general principles of this from a very strategic focus with processes and systems, and how we simplify the systems and processes and how we use it. And of course, I'm very accessible at mc@mclobster.com. If you guys ever had any questions around any of these things, please feel free to reach out. So I did block off some time for questions. I know that some folks will have a ton of questions, so I'll do my best to answer any questions at this stage that anyone has.
Yes, thank you so much, MC. I appreciate that and all the information. And if you guys have any questions right now, please go ahead and go to the Q&A box, type in your question for MC. If you would prefer to ask some of those questions offline to him, you can obviously reach out to him directly. Did you put your information on there about how they can contact you there, MC?
Yep. Yourownbankingsystem.com, and then mc@mclobster. So they can always reach out there. And I've got a couple of general questions that folks have as well that I can share. What are some of the frequently asked questions while we wait for questions, if you'd like?
Yes, that's great. I want to make something in here real quick. So there is a question on here right now. It says, what's the minimum annual premium required for this to make sense? I think it was something that you were talking about earlier.
Yeah, that's a great question, by the way, and that's one that I actually get asked quite a bit. So you can set these up for, as little as $300 a month, even with children's policies, which is very powerful, that I didn't even really cover in here for this purposes of this. But for it to actually make sense for a real estate investor to start building up some capital, you're going to have to look at it around, I would say probably around $10,000 a year. And of that, usually when these policies are structured, and I just want to put a disclaimer that this is life insurance, so it's life insurance underwriting. So there's different underwriting ratings. There could be different ages and different folks at different health. So please don't take everything I say as a blanket statement. But usually the way that these policies are structured, about 70% or more could go towards cash value from year one. So generally, when you buy just a whole life policy just out in the street that Dave Ramsey talks about, you're not going to have cash value for almost the first couple of years, right? Or not access anything. So these policies are structured for max cash. So you're going to have about 70% of that available. So I would say 10,000 is when it starts to make sense. You can obviously start small and build it up and add policies later. That's what I personally did when I started. So, but that's a great question.
Next question is which mutual companies do you usually recommend?
Yeah, that's a great question too. So when we look for carriers, okay, and when we break down mutual insurance companies, you're going to look at companies that have been around since, at least 150 years, right? Then you're going to look at companies that have been profitable for the same amount of time, you're going to look at companies, how they pay dividends. And you'd like to see dividends paid out consecutively every single year. So you look at what happened during the Great Depression, during financial crisis, during the last crisis, and all of those things. Then you look at the size of companies, and then you also look at their books. How much extra cash reserves do they have, right? Some of these companies have billions of dollars of excess cash on their books. So when you look at that, and obviously you look at the ratings, you're going to end up with a handful of them, right? You're going to end up with your Mass Mutuals, your Penn Mutuals, your Guardians. You're going to there's quite a number. Northwestern fits into there as well. And again, these are great companies. All of them. So what I then say is, because this is a strategy that's very customized. This is not off the shelf kind of stuff where you sit in front of someone and they say, well, here's your group of mutual funds basically, or here's Apple stock. So the reason why I say that is you want to actually look at what you're trying to do and the strategy that you have, because there's some companies that are less flexible than other companies, right? Of how you fund it, and then also the policy loan access. And then, that would be my answer to that. So there's some companies that's a great fit for one person, right? And then there's some companies that's a great fit for another person of how they actually want to use it and fund it. So it's not all of them are suitable for the particular strategy of every single individual. It's on a case-by-case basis. But usually for me, when I look at these companies, I don't argue, well, this one's better than that one or this one. All the companies are great. They've been around. Mutual insurance companies, these old ones are all great carriers. It just then comes into how you want to use it.
And along from the same person, it's generally with your policies, how many years until your cash surrender value outpaces the total premiums?
Yeah, that's another good question. And again, just wanted to state that it's, again, insurance. So it's not a blanket statement, but usually, you should be around, depending on underwriting and so forth, you could look at 6 to 7 years. Some cases it's earlier, depending on insurance underwriting again. So it all depends, but you're going to have access to that in the meantime as that builds up. And another thing that I also wanted to say is that this is not obviously a get-rich-quick scheme at all. This is obviously not an investment. Insurance is a savings vehicle. So this is a place where you're going to put your money as part of an overall strategy with a long-term view, because you see the big picture of how this fits into the whole puzzle.
And I also, this is the last bit of the questions that came through, but I also wanted to make sure that, you mentioned, I know you mentioned it earlier on, and there's the website there, Cashflow Ninja. I've been on the Cashflow Ninja podcast, and you have also had one of our other partners, Danny Randazzo, on your podcast. It was actually, oddly enough, released today was that episode. So I actually went to the website just now just to make sure it was on there. So on your screen right now is a link to the Cashflow Ninja podcast. So you can go there, take a listen to Danny Randazzo's episode. It's titled How to Create Your Roadmap for Financial Freedom. MC, thank you so much for taking some time to be with us here today and sharing all this good information. Looking forward to continuing to follow you, and looking forward to having you at a future summit as well.
Thank you. Thank you so much for having me. This was a blast, and thank you for everyone watching.